Hello. Hey guys, looks like we are live. Okay, testing one, two, three. We are live. Welcome everyone to another Properties and Beers. So let's get started. Lazy property strategies are dead. And here's what investors are doing now. There's a property strategy that survived Australia for decades, right? Buy an established house, accept that it loses money each week, and even use the tax depreciation to soften the damage. Then buy, hope, and pray the capital growth eventually makes the whole thing worthwhile. And you know what? That strategy is in my mind. Ever since I invested in my first property when I was 17, always carried a bit more risk than many investors realize. And I've been talking about it for years now because suddenly an established property is now losing hundreds of dollars every single week and may have to stand on its own numbers. And I think that's making a lot of investors uncomfortable. Having these conversations on a regular basis. They're looking at properties on their own or they're planning to buy and they're asking, if this asset keeps taking more money out of my pocket and I lose part of the tax benefit, you know what, Goro? Does the strategy still work? And that's a question I really want to ask today. So, you know what? We're also going to be talking about buyers who keep waiting for certainty, why the perfect buying moment rarely announces itself, and what active investors are really doing in today's market. And later on in the episode, I might even take you through one or two of the current property examples we have right now. So you can see how we assess income, demand, risk, suitability behind all of the headline yield. And you know what? I also want to respond to someone who recently told us, and get this, who said we should be thrown out of the country for helping clients achieve between 8 to 18% yields while helping ease the housing crisis massively. So there's a fair bit to cover. For anyone joining us, my name is Gaurav Gupta, CEO and founder of Ethical Property Investments. We help everyday Australians invest in high cash flow properties designed to do good and make money. That includes co-living homes, dual keys, specialist disability accommodation under the NDIS, as well as other forms of housing that can create a strong rental income while adding genuinely needed homes to the Australian market. So grab a drink, get comfortable, and that's why lazy property strategies are being exposed. Now, I'm in a public place, so I'm going to put on my earphones so I'm not distracted. I'm focused just on still right. Make sure my microphone is still pointing to the one I've got on my lapel. So just bear with me, team. Yes, it looks like we're all good still. Now, what am I doing for beers today? Those that are watching, I'm actually at the Cub office, so I've got one of their own premium lagers, right? I've got the Cub Lager. We had a great day today with what we call a core forum over at Cub. Those that don't know what Cub is, the Club of United Business, great organization to get involved with. If you've got a business that's sort of doing that $1 million plus USD, Australian dollars, sorry, not USD. And it's a great place to sort of network and really find a tribe to belong with. So they've got their own beer. Get it into you. Great taste. Brewed locally, Bayswater by Hard Road Brewing. Anyway, so here's the first question I like to ask any risky investors who owns any negatively geared property. You know what? If the tax deduction depreciate, if the tax deduction depreciate, yeah, there you go. It's live, guys. If and here's the question I'd ask: if the tax deduction disappeared tomorrow, would you still be happy to own it? And then ask a question, and you might play along. Ask this question of yourself: if the property experienced very little capital growth over the next 5 years, could you comfortably keep holding it? And you know what? Those questions, they can feel confronting. Look, you might have bought in a respected suburb. The property might look good on paper. Your accountant might have explained the tax deduction. And by the way, accountants are notorious at this. So if you're asking an accountant, they'll go, hey, tax, right? Someone may have just shown you a historical growth chart that went nicely over 20 years. Year on year growth, quarter on quarter growth. This property's done well. This area's done well. But what happens each month? Right? Are you putting in $500? Are you putting $1,000 a month? For some investors, it's considerably more. And you're paying the mortgage shortfall, right? You're effectively subsidizing your property for someone to live in. You're paying your council rent, insurance, maintenance, property management, and all those repair bills. And then tax time comes and you recover part of the loss, part of it. You still lost money to hold on to an asset. Now, a tax deduction can reduce the cost of owning an underperforming property, but it can't turn a property into a profitable investment by itself. By the way, I want to before I continue, I'm not giving you tax advice. My role is not to be an accountant. I'm not an accountant. I don't pretend to be one on the internet, right? And this is where some investors have confused the tax outcome with investment alone. My role is to help you find a high cash flow property, one where you don't have to worry about speaking to the accountant on a regular basis. And look, I do agree, tax needs to be considered. It affects all the numbers and needs proper advice from a qualified professional. But the property itself should have sound financial reason for existing before you choose for the tax benefits to be added on, especially in the current market, right? Now, correct me if I'm wrong, but for a few years, a fairly common strategy went like this: buy an established home in an area you expect it to grow, rely on future capital growth, and compensate for years of negative cash flow. And you know what? Sometimes, and only sometimes, that works extremely well. Australia's experienced periods of very, very strong property growth, and plenty of investors, they build considerable wealth in their established homes. And that, my friends, will continue, just in a different way. At the end of the day, though, what you don't see is that those results hide the pressure that's experienced in the holding period. I mean, imagine a property costing you 15, 20 grand a year to keep. That's normal investments. Over the 5 years, that's $75,000 from your household income before allowing for unexpected repairs or changes in interest rates, especially in existing property. Now, imagine the property barely moves in value during those 5 years. Can you keep going? Does your partner still feel comfortable? Right? Can you buy another property, or is the first one basically eaten into your borrowing capacity? And you know what? What happens when school fees rise for your kids? A business has a slower year, like a lot of businesses are having right now, or somebody just chooses to take time away from work because, hey, life, right? These are emotional questions beyond property because you know what? Actually, let's bring it back. The property doesn't exist separately from your life. Every shortfall competes with something that your family could have done with that money. It competes with something else, right? And I see this all the time, right? Sorry, it's properties and beers. I should be more positive. And I'll tell you why I'm not. So the recent policy change brings all of that weakness into the open and worries me. It worries me about people going down the existing property strategies that they've been down and then living in fear. Right. From 1st of July 2027, just to be really clear, investors who buy an established property after the budget night on 12th and 26th of May, from memory, won't be able to deduct its rental losses against employment income. Uh, Eligible new builds will still be able to access the gearing benefits, whether it's negative or positive. You'll still be able to access the gearing benefits. And properties held before the announcement, of course, will get grandfathered in. We've heard the word grandfather so many times. Now, this does not make every established property a poor investment. And I want to be clear, right? I want to actually have a comparison. And let me show you a bit of a comparison that I actually saw the other day that I think is really apt and I wanted to share with you, right? Let's go through it. And that is now, I did a comparison run and I want to share this with you. So if you bought brand new property at 5% versus a established property, because I'm having this conversation so much, people are like, oh, newer properties don't grow, but I believe they do. So let's compare it against established at 7%. You know what, let's play devil's advocate, say new property only grows 5%, established grows at 7%. So let's pretend you bought a property at $1 million. Sorry, just have some round numbers. Now, if you bought a property over 20 years, a $1 million property over 20 years at 5% growth, the established property would go up to 2.26. However, an established at 7% growth, assuming that it'll grow 7% with the current tax changes, will grow at 7%, will go to 2.8. So you're like, beautiful, 2.26 versus 2.89. I know what I'd rather get, and that might sound right. However, when the new capital gains changes, right, your 5% growth, let's say you sold it in 20 years. If you sold that one property in 20 years' time, you'd have 388,000 CGT for the established. However, for 7% growth, you'd have $969,000 CGT. So the established, yes, you might think it originally wins by 635,000, but it's actually loses. It actually loses. Sorry, you might think it wins by 300,000, but actually loses by more than $300,000 in the long term, even if it grows more. And this is, I'll show you some data and stats to this. I'll put it in the chat. So before I go further, here's a simple test I'd encourage investors to use, right? Take away the emotional attachment to the suburb, takes away the tax refund just for a moment, right? Then look at the property itself. Does the fundamentals stack up? How much rent does it earn? What does it cost to hold? How deep is the tenant demand itself? What could interrupt the income? Can it become cash flow positive within a realistic period, like less than 20 years? And what happens if the rate remains where it is? What happens if the rate grows? How long can you and your family hold the difference in that property? And that's where the strategy begins to unravel itself. Because honestly, a genuinely cash flow positive property gives the investor more room to breathe. And that's what it's about, right? Even today, I was speaking to an investor saying, I bought this negatively geared property in X suburb. I won't mention the name of the suburb, from Sydney. Bought it in Melbourne, and I don't know what to do. And I said, well, we need to change your portfolio. It needs to be all weather portfolio that keeps growing despite market forces, right? Because a cash flow positive property might help personal income, improve the ability to build a buffer, and create that next investment easier to consider. And at the end of the day, there is still risk, right? Positive cash flow doesn't remove these things like construction delays, vacancies, management issues, or market changes, right? But the property itself is contributing towards its own costs rather than asking the investor's own salary to do the work. And, for those risks like construction delays, vacancy, management issues, you need a good mentor to mentor you along that process, because not all positive cash flow properties are created equal. And, the thing is that once investors recognize that, another property problem usually appears. So they know the old assumptions are weaker, but they're afraid, and they've got fear around making the wrong move, right? So they wait. And sometimes fear, I believe, and I'm going to use the Tony Robbins analogy, is false evidence appearing real. And the really funny Tony Robbins analogy is F everything and run, right? That's what some investors are doing in the current market. And it's hilarious to see, right? Where I've got some investors going, yeah, let's go. Let's negotiate on this property that's supposed to be $1 million plus. We'll get it at $800,000 because we know we're smart people, we're smart investors. And other investors go, oh, wait another 6 months. Still, that $1 million property is worth 1.1, 1.2. It doesn't make any sense at all, right? So there are investors tonight who've been almost ready for 2 and 3 years too, right? And if that's you, this one's for you. So they were going to move when the rates came down. They were going to wait for the budget. And then global conflict created more uncertainty, whatever Trump did overseas. Then lending policy changed. Someone predicted a correction. Every reason sounded sensible at the time. Yet, you know what? They haven't grown their equity position. They haven't grown their family wealth. They're in the same damn position. So you see, the passive income goal, it's really not changed, right? The need to prepare for retirement has not disappeared. The gap between where they are and where they should be has had more time to grow along with inflation. And you know what? The recent conversation between Mark Boris and domain.com.au president Jason Pellegrino, they made a useful observation. And before I go through it, sorry, I need a bit of lubrication because I sometimes get animated because, they said one recent thing, and that was property buyers often react more strongly to the direction and speed of rate changes than the exact interest rate itself. When your rates move rapidly, buyers pause. They worried that the next increase could affect their budget, borrowing capacity, and lifestyle. You know what? Might be fine, especially if you're negatively geared property, right? When the direction becomes more predictable, transactions begin again. People adjust, right? They're ready to pay more for those properties. If you're not ready to pay more for your property than what you were now, might be time to look at things, because someone who previously expected to buy a 3-bedroom home might look at 2 bedrooms. An investor might lower the purchase budget or change the type of property they're considering. And the market can consider actually moving again while rates remain considerably higher than what they were before. And Daniel, you're right? It's important to explain things to people who might not have an investor mindset, because investor mindset isn't common. Otherwise, we'd all be instead of lucky millionaires, we'd be the unlucky millionaires, because we would have done it out spite of luck, right? Unfortunately, in Australia, we're all lucky millionaires because we got lucky, right? That luck is about to run out. And I've been saying this for a while now, because underlying housing demand doesn't simply disappear every time confidence falls. By the way, people still need somewhere to live. Let's call a spade a spade. Households still need to form. You can say, hey, let's reduce immigration. That doesn't fix the amount of people that we still have here who need a place to damn live. Like just in 20, what is it, 24, 25, I did some research. We were short by, what was it, about 60,000 homes. That's not necessarily get worse because people move for work, relationships, education, family. Population growth, this continues to outpace pressure, housing in many areas, creating more pressure on the housing because, you know what? I think the decision and the timing of the budget was unfortunate. When you're unsure about the next 6 months, you as an investor might choose to pause. What we saw is that smart investors bought at that time. What we saw when in rapid rate rises increased expectations, we see when government policy changes, people choose to pause, right? And you know what? It's human nature. Unfortunately, human nature doesn't make us wealthy, right? We see when the economic outlook shifts unexpectedly. Investor lending, it can slow down because investors are trying to work out what the new environment will be. And you know what? The reaction kind of understandable. You shouldn't make a financial decision while ignoring risk. Let's call it spade a spade. You shouldn't. But at the same time, there's a cost to waiting without investigating. I'll repeat that again. There's a cost to waiting without investigating because property values, they're going to move whether you're watching them or not. Construction prices are going to move whether you're watching them or not. They're going to continue to change. And your borrowing capacity might just decrease. A finance window might just close to you. And another year might just pass without building that passive income that you said you chose to, that you wanted, right? That passive income that you said that you needed for your family. And you know what? Waiting is still a decision. If you choose to wait, that's still a decision that you've chosen to sit on the fence. And even when nothing's happening, you might just get splinters, and that's what sitting on the fence is like. Yeah, and this might sound a bit harsh, but this is me speaking from my truth. A common investor mistake is trying to identify. Actually, it's a true one. A common investor mistake I see all the time is trying to identify the bottom of the market. You know, people want rates to reach the right level. They want price of property to be cheaper. They want strong evidence that growth about the return. They want to move before everyone else notices. You know what? That's not trying to catch a falling knife. It ain't gonna happen. If you're trying to catch a knife as it's falling, not gonna happen. The combination rarely appears. And those that do it get lucky. And it's nothing more than luck. It's not strategic, it's not analysis, it's guesswork and luck. And by the time the future looks safe, many other buyers can see the same information because confidence is going to return across not just to you, but the entire market. Competition's got to increase at the same time. Vendors are going to be confirmed, going, I know my shit's the best shit on the planet, right? Lenders, sorry, I have to say it out loud. Lenders are going to receive more applications. And the buyer who waited for certainty might find that their opportunities change. You're not going to buy that property that should have been worth $1 million back at $800,000 because that's what some of my buyers are doing now. That doesn't mean, by the way, you should be rushing into whatever's available. You should get some advice around it. You should get some experience behind it because property has historically rewarded investors with a well-chosen asset enough and given enough time to perform. But time alone can't rescue the wrong deal. The property still needs the right purchase price, rental demand, cash flow, location, and long-term fundamentals. And you can ask AI for an estimate to buy in areas like Yanchip, which I'm seeing a lot out there. Don't get me started on that one. I'm also saying AI recommend people invest in Northern Territory. That tools might give you a starting point, but let's be honest. If a tool is going to give you a data point, the only data point you should look at is population growth. You should not be looking at what's grown in the past because what's grown in the past won't grow in the future. This takes a lot of mindset and understanding of how the property market works. It takes a lot of investigation into the actual deal. If it means accepting that the informed property decisions are always going to contain some sort of uncertainty because property itself is a long-term asset. Don't forget that, right? If your planned holding period is shorter than the time it takes to design, build this home, you might be asking property to do something it wasn't supposed to do because, the Mark Forrest and Pellegrino conversation at Pellegrino from domain.com.au also address investors whose main goal is making a quick profit through flipping or creating investment around those tax outcomes. I actually might post that, by the way, on the chat. That thinking can be dangerous, right? That's exactly what they said. Because the property should take years to deliver full results, right? Property's not a, it's not shares. If you want to buy, hold, and buy and flip, go buy some shares. By the way, not financial advice, right? The investor needs, I believe, should have income, patience, and financial capacity to hold through periods that really could feel uncomfortable. Being strategy ready doesn't mean you're committed to buying a property right now. But you see, it means you're willing to investigate whether strategy works for your actual position. You check your borrowing capacity. You speak honestly with your partner. And by the way, that's a big one, right? A lot of property strategies I look at, they fall apart at the dining table because they speak to their partner and they realize they're on two separate planets, two separate universes, in fact, right? By the way, if you've spoken to your partner about property investing and realized you're on two different planets, drop it in the chat. I want to know what you had happen, right? I'm curious because you might bundle repayments of different interests. You decide how much monthly contribution you could comfortably make. You should test vacancy, delays, and unexpected expenses. You should also work out, and this is kind of really important, right? That your growth. Do you want capital growth? Do you want positive cash flow? A combination that can support both. Now, fear is useful when it prompts better questions, but it also becomes expensive when it creates an endless loop of vague possibilities. What if rates rise again? What if the budget prices fall? What if the budget changes something else? And you know what? Those are valid questions. But I encourage you to put numbers around them. What happens to the repayments if rates rise or fall by another 0.5%? What happens if one room remains vacant for another 8 weeks? What happens if the whole house remains vacant for 8 weeks? What happens if the build takes longer than expected? What happens if the property grows at a modest rate rather than exceptional one like it has in Melbourne? Once you test those scenarios, you find out whether what you're made of, what you're strong enough for. You discover what strategy is right for you. You might discover what needs to change. You might discover that buying now will place too much pressure on your household. And that's a useful result, right? A lot of property guys out there going, buy, buy, buy. You know what? I don't want to place extra pressure on your household. I want you to do what's right for your house, but also not live in fear. A good strategy session can lead to a decision to wait, improve borrowing capacity, or build a larger buffer before moving. The goal should not be to buy property, but it should be made to make an informed decision based on your numbers. That brings us to the fact that the investors who are currently moving forward, what are they doing differently, right? Let's chat about what active investors are doing now. Active investors are asking more than they're demanding of their property. They want to know what creates a rental income, right? They don't know what evidence of tenant demand there is, right? Or not. They examine how property performs if one part of the income is interrupted. They look at the quality of property manager, right? So they understand. They also understand that high yield on a brochure means very little if the assumptions behind it are weak. They also understand that rental guarantees don't mean shit. Pardon my French. They look at where cash flow positive investing really needs proper care. The goal can't be chasing the largest percentage available. You need to understand why the income exists and what could cause it to change. And you know what? The first thing active investors are doing is working backwards from their financial outcome. How much passive income are they trying to create? When do they need to create it? How much borrowing capacity do they have? And how much personal cash can they contribute without putting the household under strain? What level of risk can they genuinely tolerate? And then and only then should they be comparing properties. Now, I'll give you an example. A cash flow positive co-living house might suit investors seeking multiple rental incomes and greater vacancy resilience. They're like, hey, if someone moves out of one of my rooms, I should still get positive cash flow. That's what co-living usually does, right? A dual income property might suit someone wanting a more familiar residential model, but hey, two income streams is better than one. And a specialist disability combination, on the other hand, might get considerably higher income, though it comes with a lot more added complexity around design, provider relationships, and a whole heap of other stuff that you've got to make sure your ducks are lined up and right. There's no property type that automatically suits every single person we're working with, right? And that's why we made a change in the last 6 months, and that's completing the strategy work before we recommend a property. And once we recommend a property that might suit the strategy, we complete a full analysis before a client purchases. We're talking about 40 pages of data covering the local market, population trends, rental demand, comparable rents, vacancy conditions, projected cash flow, property management, field considerations, and God knows what else, right? Right? We're not even relying on suburb average to tell us about a headline yield because we want to understand how the individual property is expected to perform, what assumptions that forecast depends on, what could cause that resultant change. So, you know what? Let me show you an example. Let me talk about an example that we've got, right? Here's how the thinking works. So first, a co-living property is, priced at approximately 915,000. The projected gross rental income is up to $78,000 a year, which represents about 8.52%. That's kind of normal in our world. That's a strong income position compared with a conventional residential at a similar price point. The second opportunity is specialist disability accommodation, priced at 1.4 mil. We're talking about 140K a year, representing a gross yield of 12.43%. Now, a cash flow positive projection needs to survive more than the optimistic scenario. We see what happens when the income becomes later, expensive increase, or one source of rent interrupted. But the above two are already completed properties you can purchase right now and get that rent. Now, that's where an attractive property either becomes a serious investment candidate or gets removed from consideration. Now, these two properties aren't generic properties, as I said before. From an online list, we randomly pick for a property sales and marketing agent. Each property goes through our analysis before it's considered for a client, and every recommendation still begins with the investor's personal strategy because strategy should be key in the current market. So, you know, recently ran an ad discussing properties producing between 8 and 18%, and someone said, are you serious, mate? You need to be thrown out. I understand why the numbers can be confronting. Your experience of a property is earning $600 to $700 a week, and 8 to 12 and even 18% can sound a little bit like bullshit. But you need to look at what actually produces the income. We help develop co-living homes that help fix the housing crisis, right? We work with dual key homes that put more than one dwelling on the land. These properties, they add housing, supply. They give people somewhere suitable to live, and whether it's individuals, families, new immigrants, etc. And with a plan built and managed well, they can reduce, they can produce, positive cash flow for the investor. So how does someone being thrown out for creating more affordable and specialist housing in the middle of a housing crisis work? I'd rather contribute to the solution than spend time commenting on sidelines on someone's Instagram and Facebook, right? Because the income is connected to a real housing need that we have. That still, by the way, doesn't excuse pure due diligence, right? And I want to talk about a suburb that we had presented by a sales agent, and it was really funny. That suburb was. Oh, geez, I'm giving away a bit of the secret sauce. We had a suburb presented in the northern suburbs of Melbourne that I knew there was an issue, right? And we had, I think, what was it? We had about 3 people looking for 10 rooms. That, my friends, is a bit of an oversupply, and that's the kind of stuff we run the other direction from, right? So be wary. Not all co-living is equal. We do a whole heap of research. We do 40 pages worth of data on our properties to make sure that they're relevant and they work well, right? So you know let's bring this together. The government's negative gearing change have put a spotlight on established properties that depends on ongoing losses and personal tax deductions. So if you have a property before the budget night, maybe you might be safe. But for newer purchase of established housing, the strategy really needs to be examined carefully, and strategy is key. It doesn't mean that everyone needs to sell the established property. It means that every investor should know what it takes to carry the asset, to hold an asset. Is your rent doing enough? Can you manage the shortfall? Do you have the right mindset? Does the property have realistic path towards positive cash flow? Are you relying on things like exceptional growth of 10, 20% to justify the ordinary result today? That's a question you should ask. We also spoke about confidence, right? Investors pause when rates, policy, economic expectations move quickly. But uncertainty usually arrives after markets already begun responding. And my friend, you don't need to pick the exact one. What you need is a strategy that can survive a range of possible outcomes. And finally, we looked at what active investors do now. They're testing their finances before choosing a property. They're investing in the source of rental demand. They also look for cash flow positive opportunities that add housing that can be held for the long term. They're also willing to walk away when the numbers don't fit. And if this exposes raised questions if this episode, has raised questions for one of your current properties, or you'd like to test whether positive cash flow strategy could work with you, reach out to the team. We can go through your goals, borrowing position, current portfolio, and then test the available options. And you might be ready to move now. You might need to prepare for another 6 to 12 months. You might find that one of these strategies doesn't suit you at all. We would rather help you reach an informed answer than recommend a property that places unnecessary pressure on your life. Now, before you go, reach out, check out Ethical Property Investments on Facebook and Instagram. You know, check it out. You might be missing out on market updates, property breakdowns, or investor education. Otherwise, search for us on Facebook. You can also choose to subscribe to our weekly cash flow memo. That's completely free. Each edition shares practical property insights, commentary on what we're seeing in the market, and a few snippets of our current opportunities being reviewed in a yield club. And it's useful way to see what kind of properties our clients get exclusive access to. So thank you for joining me for another episode of Properties and Beers at the Cub Office, guys. Um, have a great evening. Enjoy your drink. Have a great weekend, and don't do anything I wouldn't do, kids. See you later.